tax the rich. The California government recently turned this slogan into concrete action. Proposition 30. The goal was simple: impose a one-time 5% tax on the net worth of the state's 255 billionaires. The government did the math. Once this sickle swung, it would harvest $100 billion within 5 years, enough to cover the state's healthcare funding gap 3 times over. Sounds perfect, right? But reality gave California a resounding slap in the face. Before the proposal even landed, the money had already run away. If John D. Rockefeller could wake up today from his slumber in a New York cemetery and see this ambitious proposal from the California government, he would likely let out that iconic sneer, tinged with a hint of pity. Today's Rockefellers, the tech moguls controlling modern digital empires, like Google founders Sergey Brin and Larry Page, Palantir founder Peter Thiel, or even the king of SPACs, Chamath Palihapitiya, have perfectly inherited the survival wisdom left by old money families a century ago. While California's tax collectors were still in their offices punching calculators, fantasizing about how to spend that $100 billion, this group of tycoons made the only and most fatal response: evacuation. According to statistics, since California let slip the rumor that it was going to hunt the rich, nearly $1 trillion in wealth has evaporated from California's books like steam in the sunlight. Of the $100 billion in tax revenue originally projected, half of it, a full $50 billion, vanished without a trace before the tax auditors even stepped out their doors. This is the first lesson governments never seem to learn. You cannot tax a ghost. This is not the first time in human history this naive mistake has been made. Let's pull our gaze back to Europe in 1982. The French government at the time faced a fiscal deficit and thought it had found a panacea: a wealth tax. The logic was exactly the same as California's today. The rich have so much money. It is their obligation to pay back to society. The result? An economic catastrophe. The wealthy in France did not obediently line up to pay. They did the only logical thing. They left. They took not just the numbers in their bank accounts, but their corporate headquarters, their investments in high-end manufacturing, and the jobs that originally belonged to France. During the period it attempted to levy a wealth tax, France lost up to 3.5 billion euros in tax base annually due to capital flight. Sweden tried it. Norway tried it too. In Norway, when the government decided to slightly increase the asset tax rate on the rich, $54 billion in private wealth flowed out of this small Nordic country in just 1 year. These tycoons moved collectively to Switzerland, the ultimate safe haven for capital. For families on the level of the Rockefellers, national borders are merely dotted lines on a map, not walls that confine them. Their wealth is fluid, like mercury. When you try to use a net designed for fixed assets to catch mercury, you will find your hands empty, while the mercury has long since flowed into the cracks of the floor, gathering in a safer place. So, while the hunters in California are still sharpening their knives, the real foxes are already standing on the mountaintop, watching it all coldly. They don't even need to mock it, because to them, this is just another boring repetition of history. If fleeing is the instinctive reaction of the rich when facing threats, then for the true dynasties with deep roots and century-long legacies, fleeing actually looks a bit undignified. The true top players, like the old Rockefeller, and the contemporary heirs who have fully mastered his essence, do not need to leave the United States at all. They don't even need to leave their exorbitant Manhattan penthouses to ensure the taxman can't find a single cent of taxable income. This is the first seal Rockefeller left for future generations: a magic trick regarding poverty. We call it buy, borrow, die. If you ever have the chance to see the private annual financial statement of a top billionaire, you might be confused, perhaps even falling under the illusion that he is pitiful. Imagine we walk into the study of a contemporary Rockefeller heir. Let's call him Julian. Julian is worth $200 billion. He just bought a private island in Hawaii. His garage is full of limited edition sports cars, and his private jet is on standby to fly to Paris or Tokyo. At this moment, a righteous tax auditor knocks on the door. Holding a thick book of tax codes, the auditor thinks, "This guy is so rich. His life is so extravagant. His income tax bill this year must be astronomical. I'm going to fine him heavily and teach him about social fairness." But when the auditor opens Julian's annual ledger, his smile freezes. The number in the taxable income column is pitifully low, perhaps even close to zero. Even more absurdly, on the balance sheet, Julian not only lacks piles of cash, but carries hundreds of millions, even billions, in huge debts. The auditor is furious, feeling his intelligence has been insulted. "This is impossible. You own tens of billions in stocks. You own that yacht docked in the harbor. How can you be a pauper? Where does your money come from?" Julian would smile and teach him a lesson. This lesson reveals the most essential difference between the world of the rich and the world of ordinary people. In the ordinary world, survival logic is linear. You work hard, sell your time and skills, and the boss pays you a salary. This money is called income. The government watches this income like a hawk, slicing off 30% to 40% in taxes first, and then you use the remaining money to buy a house, a car, and bread. But in the Rockefeller world, income is something only fools touch. What Julian holds are shares in the family business. These stocks are invaluable. They might go up by $1 billion today and $2 billion tomorrow. But legally, as long as he doesn't sell these stocks, this accumulated wealth is just paper wealth. They are not realized gains. They are not income. So the government cannot collect a cent in tax. Then you ask, if he doesn't sell stocks, where does the money come from to buy islands? Where does the money come from to pay the butler, the bodyguards, and the pilots? This is where the magic happens. Julian won't sell stocks because selling stocks incurs a capital gains tax of over 20%. That's too expensive. That's a waste of capital. Instead, he walks into a bank, slaps that thick stack of stock certificates on the table as collateral, and says to the banker, "I want $100 million in cash." The banker will write him a check without hesitation, or even give him a black card with no limit. Why? Because Julian has hundreds of billions in stocks as collateral. Lending him money is the safest business in the world. Moreover, the interest on these mortgage loans for the super rich is shockingly low, perhaps only 1% or 2%. Now, Julian has $100 million in cold, hard cash. He takes this money to splurge, to enjoy an imperial life. Here is the key point. Listen closely. In the eyes of the IRS, what is this $100 million that flowed into Julian's pocket? Is it a salary? No. Is it a dividend? No. Is it profit? No. It is debt. According to all current tax laws of humanity, from ancient times to the present, you do not need to pay tax on borrowed money. This is why reality tycoons like Larry Ellison, founder of Oracle, can buy 98% of Lanai Island in Hawaii and live a life of extreme luxury year-round without selling Oracle stock to pay the bills. This is also why Elon Musk and Jeff Bezos pay pitifully little income tax in certain years, sometimes even less than their secretaries. They are not evading taxes. They are utilizing the underlying logic of the rules. They live by borrowing money, not by earning money. On Julian's ledger, he possesses infinite debt, and the interest generated by that debt can, in some cases, even be used to deduct costs, further lowering his tax burden. This forms a perfect closed loop. His assets are constantly appreciating, tax-free. His consumption funds come from loans, tax-free. And his interest payments help him avoid taxes. In the current tax system, Julian is an invisible man. He is like a giant wearing an invisibility cloak, eating and drinking heavily in the room, while the IRS camera can only capture an empty chair. This strategy is so efficient that it has become standard for top billionaires. Statistics show that U.S. individuals currently hold up to $140 billion in outstanding stock-backed loans. This isn't just a number. It is $140 billion in tax-free cash flow, a massive tunnel dug by the rich within this system. So, is the government really helpless against this? Actually, the method to crack this magic trick is very simple. Simple enough to scare all the rich. This is also why you rarely hear anyone discussing this solution in the mainstream media. If the government really wants to catch this fox named Julian, they shouldn't stare at those ethereal company valuations, nor should they obsess over whether he ran off to Switzerland. The government should stare at the action named loan. Imagine if the tax law added a clause. Any huge consumption loan obtained with assets as collateral is deemed an asset sale and must be subject to income tax. This means the moment Julian gets that $100 million loan from the bank, the IRS appears. Because in substance, spending borrowed money and spending money from sold stocks is the same. Both convert paper wealth into purchasing power. Since selling stocks is taxed, why shouldn't borrowing be? This is an extremely precise strike. Bank loan records cannot be faked. Every penny is traceable. It doesn't require complex valuations, nor does it require chasing assets overseas. As long as you dare to borrow money to consume, you have to pay tax. This would force all the Julians to face a painful choice. Either stop this game of avoiding tax through debt and obediently sell stocks to cash out, thereby paying capital gains tax, or continue borrowing but pay the price for this tax-free cash flow. But this is merely the first layer of camouflage. If debt tax avoidance is the magic Julian performs while alive, his game in the mortal world, then when he faces humanity's ultimate fate, death, the Rockefeller family has an even more astonishing setup. If debt tax avoidance is the game of the rich in the land of the living, then this next setup is the Rockefeller family's complete subversion of the order of the underworld. In the United States, death is usually seen as the terminal station for taxation and the government's final carnival. Federal law mandates an estate tax as high as 40%. This isn't just a number. It's a sword of Damocles hanging over every rich person's head. By common logic, the moment a billionaire takes their last breath, no matter how shrewd they were in life, nearly half of their accumulated empire should be sliced away. This was originally intended to be the most important mechanism for the redistribution of social wealth, especially right now, as the U.S. stands on the threshold of the largest wealth transfer in human history. Over the next 20 years, an estimated $84 trillion in assets will pass from the older generation of the wealthy to the next. If this money were cash, stacked up, it could reach the moon and back several times. The government, knife in hand, has long been ready to take its share at that grand funeral. But Julian, the Rockefeller heir, only sneers at this. Because in his family story, death has been cancelled. This sounds like science fiction, but legally, it is entirely feasible. As early as 100 years ago, old John D. Rockefeller saw through this. He realized that as long as wealth belongs to an individual, then when the person dies, the tax is borne. It cannot be avoided. The only way to crack it is to detach wealth from the mortal body and grant it eternal life. So, he created that famous masterpiece that drives all tax auditors to despair, the Dynasty Trust. This is a true contract of immortality. Let's dismantle the core of this magic trick to see how it works. When old Rockefeller was still alive, he didn't leave the money directly to Junior Rockefeller in his will, because that transfers via inheritance and must be taxed. Instead, he stripped the massive assets from his personal name and injected them into a cold, legal entity that never dies, a trust. In this structure, the Rockefeller descendants, whether the second generation, the third, or today's Julian, do not actually own this money. In legal documents, they are merely beneficiaries of the trust. This is a genius word game and a massive legal black hole. Julian can draw money from the trust, live in houses bought by the trust, fly in planes bought by the trust, and even direct the trust's investment direction. But legally, he does not have ownership of the assets. What does this mean? It means that when Julian's father died, legally, no assets were transferred. Because the assets were sitting safely in that undying trust, never having moved. Since there was no transfer, there was no need to pay estate tax. When Julian dies in the future, the same thing will happen again. This trust is like an invisible force field, protecting family wealth as it is passed down from generation to generation, completely dodging that 40% estate tax blade. The snowball that should have been sliced in half by the government every generation now rolls unharmed through centuries under the trust's protection, getting bigger and bigger. This is why you see real-world dynasties like the Rockefellers, the Waltons, Walmart, and the Mars family, Candy, breaking the curse that wealth does not survive 3 generations. Their wealth hasn't been diluted by reproduction. Instead, it has expanded constantly due to perfect tax avoidance structures. This structure produces an extremely ironic, even cruel social consequence. It manufactures a class of permanent aristocrats. Those heirs known as Nepo babies. They might lack any business talent, might never work a day in their lives, or contribute nothing to society. But simply because they hold the key to the trust's vault, they command more resources than the innovators who actually change the world. As the data points out, this inheritance mechanism actually suppresses innovation. If a young person sits on billions just because of their last name, what motivation do they have to take risks? What motivation do they have to work desperately, like Jobs or Musk? Their only task is to guard the trust and not let it collapse. This is not just a loss of tax revenue. This is the corrosion of the spirit of capitalism. Some might ask, doesn't the government know about this loophole? The government certainly knows, but these trust structures, such as intentionally defective grantor trusts, are tightly wrapped in layers of legal text. This is a game that requires not only money, but top-tier legal teams to play. And this is exactly why true class solidification often happens in legal documents you cannot see, rather than in news headlines. With debt to avoid income tax and trusts to avoid estate tax, the Rockefeller family's defense system is already near perfect. But to keep this massive empire running, to make money beget money within the trust, the family needs a group of special helpers. This leads to the system's third giant loophole, a backdoor left specifically for insiders: carried interest. The Rockefeller family's money won't breed by itself. It requires Wall Street's top brains to operate, namely the managers of hedge funds and private equity funds. This group is the gatekeeper of family wealth and a co-conspirator in this system. Let's look at how these emperors of employment avoid taxes. Suppose Julian hires a top fund manager to manage family assets. Through shrewd investing, this manager helps the family make $1 billion. According to the industry standard 2 and 20 rule, the manager charges a 2% management fee and takes 20% of the profits as compensation. That is, $200 million. Stop and think. What is this $200 million essentially? It is compensation earned by the manager through labor, right? He gave time, intellect, and stress in exchange for this money. By common logic, this should count as salary and be subject to the highest bracket of personal income tax, which is 37% in the US. But, through powerful lobbying, these Wall Street magicians got the tax code to recognize this money not as wages, but as investment income. Even if the manager didn't invest a penny of his own principal, even if he is just managing other people's money, this income is still calculated as capital gains. Thus, the tax rate magically drops from 37% to around 20%. This is the most absurd part of the system. A fund manager who moves his fingers on Wall Street to manage money for the rich pays a lower tax rate than a doctor who saves lives in the ER every day for a fixed salary. Every cent the doctor earns is hard money, taxed at the highest rate, while the astronomical figures earned by the fund manager enjoy tax privileges. This is a privilege designed specifically for the butlers of the rich. It is estimated that because of this single loophole alone, the U.S. Treasury loses nearly $100 billion in potential tax revenue annually, if broader capital gains preferences are included. At this point, a perfect closed loop is formed. The Rockefeller family, Julian, turns consumption into debt via the buy, borrow, die strategy, avoiding income tax. The Rockefeller family, holistic, turns assets into ghosts via dynasty trusts, avoiding estate tax. The family's accomplices, Wall Street, turn wages into investment income via carried interest, enjoying low tax rate privileges. These three layers of mazes stack together to form a barrier that ordinary people cannot surmount. Inside this barrier, wealth flows freely. Outside the barrier is the tax-paying world we know. At this point in the story, anger is normal. You might think, if we just elect politicians who are tough enough, if we pass laws that are strict enough to plug all these holes and confiscate all their money, the world will get better, right? This brings us back to the story's most disturbing ultimate twist. Let's do a thought experiment. Suppose tomorrow the government actually wins. They miraculously plug all the loopholes, confiscate the Rockefeller wealth, and get that dreamed-of $100 billion, or even more. Then what? Will this money actually solve the problem? The data throws a bucket of cold water on us. We must recognize a fact. The U.S. government is not short of money. In fact, the U.S. is already one of the most frantically taxing nations on the planet. According to OECD data, Total annual tax revenue for U.S. governments at all levels is as high as $7.4 trillion. What is this concept? Even taking population into account, U.S. per capita tax revenue exceeds that of so-called high welfare states like Germany, the UK, and France. If calculated per head, the money the U.S. government takes from everyone is more than those European countries known for high taxes. But the result? Despite pouring in such massive funds, the U.S. healthcare system remains the most expensive and least efficient in the world. U.S. per capita healthcare spending is double that of other developed countries, yet life expectancy ranks at the bottom among them. Despite collecting so much money, in the defense sector, public news reports show the Pentagon fails asset audits repeatedly, with hundreds of billions of dollars in funding untraceable, as if falling into a giant black hole. This is the cruel revelation given to us by the famous Parkinson's Law. Expenditure rises to meet income. The reason the Rockefeller family wins, the reason they can design these tax avoidance structures with peace of mind, is not just because they are greedy, but because they have seen through the nature of their opponent. In their eyes, the government is like a giant bucket with a hole in the bottom. No matter how much water you pour in, whether it's the $100 billion snatched from the rich or the $1 trillion printed by the mint, as long as you don't patch the hole representing inefficiency and waste, the water level will never rise. If we only focus on how to grab money from the rich while ignoring how the government spends money, then even if we confiscate the property of all billionaires, it is merely adding a few more drops of water to that leaky bucket. These drops will leak out instantly, and the social problems will remain. So, while California politicians are still shouting, "Tax the rich," and while headlines are still debating that 5% net worth tax, the true Rockefellers are looking down on it all from the clouds. They hold that black card that never declines, stand backed by that group of fund managers paying only a 20% tax rate, and stand upon that eternal dynasty trust. They know that as long as the underlying logic of the system doesn't change, as long as the three pillars of debt is not taxed, trusts do not die, and spending is unchecked remain, the result of this cat and mouse game will never change. You cannot tax a ghost, and the people who make the rules are often the very ones who possess the mediumship to commune with them. This is not just a story about money. It is a story about rules. And in this story, the cruelest truth may be: the rich do not own money. They control the flow of money, while the poor and the middle class are merely the riverbed over which the money flows.